Hello, Ira Coiner here from Triathlon Partners TV. Thanks again for tuning in today. I want to thank all our subscribers, all our fans. You guys really have been great, really make this happen for us. It's fantastic. Now, today's topic that we're going to discuss is IRAs, and I can't think of a better person to bring this to you than Ira Coiner, right? This is really up my alley. I was born to do this stuff. So let's go forward. Now, the main thing about IRAs, right, is that they are tax advantaged accounts, right? So if you are going to prioritize yourself, be a champion saver, and make sure you do the best job possible to save for your retirement or other financial goals and objectives, you have to get involved with an IRA. And there are a couple of different types of accounts. The thing to remember about them is once the money is in these IRAs, they grow tax deferred. You do not pay money when on the gains, the interest, the dividends, what have you, while that money sits in the account, which is great, right? That's the quickest way to grow your money. Is not pay taxes, is to keep most of it, right? Or in this case, to keep all of it while it sits in your account, right? And, so that's the main reason and why they're fantastic investments. So there are two types, two popular types of IRAs. One is called a traditional IRA, that's the original one. And the other one's a Roth. Now, a traditional IRA, the money goes in to the account pre-tax, which basically means on your tax return, you say, I'm going to contribute to my traditional IRA, and I'm going to do the limit, which this year is $7,000 for people under 50. And they're going to take on your tax return $7,000 off your income that you declare, and hence you're going to be paying taxes on a lower income level. That $7,000 that lowers your income goes straight into the traditional IRA. So you didn't pay taxes on it, right? So that's great. So if your tax rate was 30%, if you wanted $7,000, you'd have to earn $10,000. $3,000 would go to the government, $7,000 you would have it. You'd invest that. But this way, you have $7,000 that come off your income, and $7,000 goes into the bank. So you're left with an extra $3,000 when you choose to save in the traditional IRA. Now, a Roth IRA is different in the sense that the money goes into the Roth IRA after taxes. You've already paid taxes on the money, and then you put it in the Roth IRA, and the money grows tax-free. You don't pay on the taxes, on the gains, the interest, or the dividends. Now, the difference is when you withdraw the money from these accounts. When you withdraw money from a traditional IRA, all of it is taxed as income. You've never paid taxes on it, so you pay taxes eventually, you pay it at the end, right? When you withdraw the money. As long as the money's in the account, taxes aren't paid. The Roth IRA, because you've already paid the taxes on it, grows tax-free and can be withdrawn tax-free, right? There are other nuances, which are all more about when you withdraw, which is really more about a retirement spending strategy. So we won't get into that now, because really what we want to do is to make sure you have all the tools and you're ready to invest and save and grow your money as efficiently as possible. So there are limits in terms of how much you can put in every year in your IRA. I said before, it's $7,000 for 2024, and you have up until April 15th of 2025 to decide if you wanted to contribute for 2024. Hence that the April 15th is when your taxes have to be filed. So you get to make that decision then, and you'll sort of know your overall tax bill. And that's the best way to do it for you to manage if you can contribute. Now, there are limits on who can contribute based on their earned income for the year. right? So for a Roth IRA, there are definite limits. The government does not want very wealthy people putting money in and growing tax-free and being withdrawn tax-free, right? It's just supposed to encourage lower income, middle income families to start savings for themselves. So there's a limit that for single people, $138,000 a year, married couples for $218,000. If you're married and one of the spouses does not work, they are entitled to contribute. It's based on that income level. And, it's really important to know these things, to know what your choices are. After above those income levels, pretty quickly it phases out and you're not really eligible to invest the money there. There are ways to go around it, but we're not going to go into that right now. Now, while we're on the topic of tax-advantaged savings vehicles, there are a lot of other ones out there, right? That they have some properties like the IRAs, they have different properties, but there's something to know about because, again, they're tax-advantaged to some way or another, and which really benefits you and the way that your money grows. So 401k, if you're familiar with that from your workplace or job, it's fantastic. Right? The money goes in like a traditional IRA. The money that's invested does not count as earned income for the year. It goes into the account. The money sits there. It grows tax deferred. And when the money is withdrawn, that's when you pay taxes. But another reason, and more importantly, and why it's probably better than a traditional IRA, is that most employers contribute to your annual contribution. They typically call the match. So whatever you put in, they also put in up to a limit. So if you don't take advantage of your match, that money is lost, right? You got to be aggressive. You got to make sure you get that money and you maximize that match, right? There are limits on how much you can put into your 401k every year. And if you do have access to a 401k, your ability to contribute to traditional Roth IRAs is compromised, severely limited, but the limit on your 401k contribution is much higher. If you are a single self-employed individual, there are things called a SEP IRA, which does have a much bigger limit on how much you can contribute, as well as a limit on that can't be more than 25% of your income. But that's also very similar, goes in tax-free, earns money tax deferred, and then when you withdraw the money, it's taxed. Great, very similar to a solo 401k for high net worth individuals, right? Something that's fantastic, people might not realize that there is something called a high deductible health care plan. When you have a high deductible health care plan, medical insurance, you're able to open up what's called a health savings account, which means it's not a flexible spending account, it's a health savings account. The money that you contribute to your health savings account goes in pre-tax. You're not taxed on this money at all. The money in this health savings account grows tax-free. It's just like a health savings account. It's put into like a brokerage account, but its tax status is it's tax-free. Then when you withdraw the money for qualified medical expenses, the money is withdrawn tax-free. You've never paid money on these taxes. It's great. You can save if you're young and you use a high deductible plan, money stays, it doesn't go away after a year. The money can just keep on getting invested. And when you're older, you have an emergency that you have big healthcare expenses, then you can use it. It's really a fantastic tool. You can even use it to pay for long-term care insurance if that's something you wanted to do. There are other types of accounts that are also tax advantage. Life insurance, if you buy cash value, universal life, index universal life, or whole life insurance, money in the investment account there grows tax deferred. And if your policy is structured properly, the money can be withdrawn tax exempt. Also, when that money would go to fuel a death benefit, increasing your death benefit. When you pass away, death benefits are paid without paying any income taxes or paying any capital gains taxes, right? So that's another way to save money and plan for your future, your family's future. Also, annuities are just like 401ks in the sense of they're all post-tax money, but the money grows tax-free. It sits in the account, grows tax-free, got plenty of different investment opportunities. And these are all accounts that when you're looking to save and prioritize yourself, that you got to know about. And it's just beyond the IRAs, but these are types of accounts, and the way to save and prioritizing them really makes a difference in terms of you reaching your financial goals and objectives. All right. Well, thank you very much for tuning in, everyone. I'm going to be sharing with you the disclaimers. And you guys have yourself a very blessed day. Sorry, guys.